Okay, so I'm going to start the session. I'm going to obviously look at the notes first, and then we'll go and we'll actually look at the study guide. We'll go through what content they've given you there. Just look at the contents page. You can see that it's quite a short section. There's not too much. Around 14 pages in total, obviously taking the questions into consideration as well. You'll see with Learning Unit 5, we're focusing on the next step of that taxable income calculation. If you can picture that diagram in your mind's eye, where you've got taxable income right at the bottom and then you've got gross income right at the top. Last week we looked at the income part. This week we're looking at the deductions. Okay, so this is a very, very important section purely from a application point of view. Do you want more or less deductions as a business?
More deductions.
Exactly. So you want to possibly deduct or to provide for an allowance for as many possible things as you can possibly list, because you don't want to pay more tax, you want to pay less tax. So Learning Unit 5 or Study Unit 5 is actually one of the most important sections when looking at application, because it addresses the deductions part of any taxable income calculation. Right, so let's have a look at it. This is just some recap from last week, just to highlight some important points that we obviously covered, but that relates to what we're looking at this week. The first thing is obviously the difference between a non-resident and a resident. What is the difference, and how does that affect the taxpayer?
Okay, so I know there's a criteria to be a resident, and the key word is worldwide. So a resident is taxed on their worldwide income.
Perfect. Okay, that's important to note, because this is obviously what we're looking at in terms of SARS, okay, because we're living in South Africa. If SARS considers you a resident, it doesn't matter which country you're from, it doesn't matter where you consider, inverted commas, home. If you're considered a resident, which you can possibly be considered a resident if you meet certain criteria. Obviously, worldwide income, meaning I can earn income across the world and I still need to pay tax on it in South Africa, which is problematic, especially if you've got other income sources from other places. Okay, obviously, in South Africa, we know that the highest tax rate in the country for an individual is 45%. Okay, that's quite high compared to other countries around the world, but it's a sliding scale. So obviously, the less you earn, the less tax you pay. The more you earn, the more tax you pay. Okay, we spoke about that as part of the tax administration, where we said in South Africa we have a progressive system and we also have a proportional system. Proportional means you just pay a portion, so a fixed percentage. Okay, that could be something like company tax. Companies pay 28%, flat rates. Obviously, they can be classified as a SBC or a micro business, and then they would obviously use a sliding scale as well. Okay, so resident is good. Non-resident,
So non-resident would be somebody who does not, wait, how can I put it? They just get an income from South Africa,
yes,
but they don't necessarily live here.
good. Okay, so as you said, the SA source. Right, so we have someone coming to South Africa, working for a month, 31 days, and then they leave to go back to their country. Okay, maybe they're a contractor, maybe they're working for their company in the country, whatever the case might be. But assuming that they're earning income directly from South Africa, as a non-resident, they would have to pay South African income tax, okay, source. Right, so for example, we spoke about Uber last week. Just to use the same example, obviously Uber operates in South Africa. Okay, Uber will have to pay tax on their South African source of income. So in other words, all the rides and all the deliveries that they do in South Africa, that would be subject to tax as a non-resident. Okay, obviously Uber also operates in the US. Okay, it's obviously an American company, but South Africa is not going to tax their revenue in the US. Okay, that wouldn't be fair, right? Because that revenue is outside the country, and obviously Uber wouldn't be considered a resident of the country, right? They could, But if they're considered a resident, then we need to look at this. Oh, I lost my cursor. There's it here. Okay, economic nexus, place of effective management, operational management, and those are things that you need to consider when motivating whether a company is a resident or a non-resident. Okay, so with natural persons, okay, with individuals, so you and I. With you and I, SARS will apply the ordinarily resident test or the physical presence test. Obviously, if you're a company, you're juristic, and then they're going to be looking at that. The effective management, operational management, the economic nexus. Okay, this I haven't seen them test. They don't really test that because they don't really cover it. Okay, they test this. I've seen past paper questions where they've asked students to discuss whether a company would be considered a resident or a non-resident based on the case study. Okay, so UNISA gives you a case study.
Just a question. What is the last one, economic nexus?
Okay, good question. So economic nexus means where do you derive most of your profit or your income? So you might have, let's say you might have a company operating in, let's say, South Africa, Namibia, and Botswana. Okay, maybe even Zimbabwe. Okay, our neighboring countries, and then Swaziland and Lesotho. Those are other countries that are part of our neighbors. Okay, so if you are a South African company, okay, obviously you would be operating in South Africa. So let's take like MTN for example. Okay, MTN operates in a lot of different African countries. Okay, MTN is more of an African company than a South African company. Obviously, they started off as a South African company, but they've grown so much, and they offer services in so many other countries in Africa that you would generally consider them more African rather than South African, right? Because they've got lots of different countries where they operate. But if we look at MTN as a company, where do they have the effective management? Obviously, South Africa. Okay, operational management, obviously South Africa. Economic nexus, also probably South Africa. But Nigeria is obviously quite an important. Quite an important, let's call it country, okay, or business unit or economic location. Okay, so the economic nexus is something to consider. Remember, none of this is set in stone. Okay, remember, some of this could be taken to court. So, for example, let's just say Uber. Let's assume that Uber was created in the US. But let's assume that in South Africa, because Uber is operating in South Africa and they're making so much money in South Africa that the nexus, in other words, where do they derive most of their profit, comes from South Africa. Then there could be a question mark here around whether they are juristic and whether they're a resident or a non-resident. Okay, you can have foreign companies that have been created outside of the country. Okay, but they operate inside the country, and as an economic nexus, they derive the majority of the income. Let's say like 90% of the income. 90% of the income comes from South Africa. Okay, then SARS could maybe say, well, because your economic nexus is in South Africa, we're actually going to consider you more as a South African company, as a resident rather than a non-resident. Because the thing is, you're deriving 90% of your income from this country, then surely you should pay tax in this country for the country, because the country is such an important economic nexus. So like a nexus is just like, nexus actually like, it comes from a Latin term. I forget what the term actually is. Do I have my Google? Yeah, I have it open here on the other side, on the other screen. Let me just get to Google and I can just search for nexus here, just so you can see the definition. It's like the main point, nexus. Okay, central or focal point there. Okay, so where is your economic focal point, your economic central location? Okay, so the nexus would be like, where do you derive most of your income? Okay, your profit, all of that. Does that make sense?
Yes.
Okay, so you can have a company that is foreign, but because they rely so much on a particular country, let's say they're operating in South Africa and most of their revenue comes from South Africa. Maybe like a small country like Swaziland. Okay, obviously Swaziland is a very small country, okay? And let's assume that they've got a business. You've started a company, a PTY Ltd. Okay, it might not be PTY Ltd. It's obviously in line with that legislation. So whatever Swaziland uses to register their companies. Okay, PTY Ltd obviously relates to South Africa. Okay, so however you're registered in Swaziland, whatever they use, okay, it might be like incorporated, it might be something completely different. Okay, I don't know what the legal, let's call it postfix, that's used for companies in Swaziland. Okay, so let's just call it ABC. Okay, if ABC is a company in Swaziland, but they were created in Swaziland, but they operate throughout South Africa as well. Okay, and obviously, based on their economic nexus, they make 90% of their profit in South Africa, and only 10% actually comes from Swaziland itself. Okay, because Swaziland is smaller, obviously South Africa is a lot bigger, so in terms of earnings, they get most of their earnings from South Africa. Okay, operational management. Okay, they might have an office in Swaziland and in South Africa. Okay, and then the government or SARS will say, well, you've actually got two offices, one in Swaziland and one in South Africa. Operational management, obviously the South African operations are a lot bigger. The government might say, well, or SARS might say, well, we think and we motivate your operational management is actually in South Africa. Place of effective management might be in Swaziland, but they might say, well, you tick two of the boxes, okay? Effective management, they can obviously motivate, well, obviously if you've operated in South Africa and you've got most of your money coming from South Africa, they might vouch or provide evidence that your effective management is actually in South Africa. And if they can prove that, and they can prove that you're a juristic resident, then you'd have to pay resident tax in South Africa. Okay, so basically economic nexus, it's just a consideration. Remember, none of this is set in stone. Okay, it's obviously a consideration. It's stuff that SARS will consider when they tax different taxpayers. Okay, so all taxpayers have to contribute towards the fiscus. Okay, as a taxpayer, you could be a resident or a non-resident. As a resident or a non-resident, you could be considered a natural person or a juristic person. Okay, obviously if you're juristic, they're going to use a different test. Okay, these are tests that have to apply. If you tick all the boxes, you're a resident. If you don't tick all the boxes, then you're a non-resident. Okay, so obviously businesses would rather be a non-resident than a resident. Why? Why would you rather be a non-resident than a resident?
Because you would pay less tax.
Exactly. Okay, you don't want to pay more tax, you want to pay less tax.
Less tax.
Correct. Maybe just to share something with you that I saw earlier today. Actually, I was watching during a break. I saw something on one of the news channels. Let me just see if I can find it. USA Global Tax Proposal. I forget what the... Here's it. There we go. Okay, this is actually news that just happened a day ago, basically. So I don't know if you're aware of the change in the... they call it the Fed. Okay, so the Fed, the head of the Fed, okay, the Federal Reserve in America. In other words, like, so for example, the central bank in America. So in South Africa, our central bank, okay, is the South African Reserve Bank. In America, the central bank is headed up by this woman, okay, Janet Yellen. Okay, she's very popular. She was actually part of the whole setup pre-Trump. Okay, obviously Trump changed things a bit, but now with Biden, Yellen is now in power. When I say power, she's obviously the head of the central bank, and she's calling for a global minimum corporate tax. Okay, and the reason for that is because we actually spoke about tax havens in one of our weeks. A tax haven. So, for example, the Cayman Islands, the British, what is the British Virgin Islands? What are the other ones? There's a few other ones. I forget the other ones, but there's a few tax havens in the world, and those tax havens are beneficial for companies that operate in those places. I think Isle of Man as well. Okay, I'm not getting a list of them, but your Isle of Man, there's a few. There's a few of these places around the world, and what this lady is proposing is that she wants companies across the world, irrespective of which country they're operating in, to pay a minimum corporate tax. Okay, so in other words, because governments are obviously dealing with like COVID and the financial like crisis from the actual pandemic, governments need more money, and governments, including America, want to collect as much taxes as possible. So I don't know if this is actually gonna if this is gonna happen or not, but it's a debate, and the EU is also supporting America regarding this global minimum tax. So yeah, it's going to be interesting, and this is obviously related to tax, but it's something that's going to affect the world, because some companies that operate in certain countries don't actually pay any tax, and that's obviously a concern. Okay, so you can go to any of these websites. Reuters is a good source of information, Bloomberg, Washington Post, all of these. They're very reputable news broadcasters, and that's what they're talking about at the moment. Okay, 21% global tax. Okay, if this goes through, it's going to be quite a, how can I put it, like a historical event, because nothing like this has ever happened where you have a global tax. I mean, you have tax, but tax is generally unique to a specific location. So in South Africa, we have tax, but we have South African tax. In America, you have American tax. In different European countries, you have European tax. But now they're talking about a global tax. So big companies, big corporates that earn like billions or trillions of rands, or trillions of dollars, or billions of dollars, however big they are, obviously try and make use of certain exemptions, tax havens, etc., to stop or to not pay any tax or to pay less tax. And obviously, the Europeans and the Americans don't want that to happen. They want all those companies, irrespective of where they are, to pay tax. Right. So this is something quite fascinating, and I don't know how this is going to affect like companies and the markets and all of that, but it's definitely something to keep your eye on, because if this does go through, those very, very, very large companies and those companies that do take advantage of those tax havens are obviously going to be affected, and they're going to have to pay more tax. Right. So whether this happens or doesn't happen, it's still new. It's all talk at the moment. Okay, it's very similar to what we saw in that information that you shared with us last time. You spoke about the corporate tax in South Africa possibly reducing to 27%. That's a proposal. It's just talk. It might come true, but it has to go through like all sorts of regulation, and only once it's passed in Parliament. So even something like this needs to be consulted globally. So obviously, America and the EU are trying to like support this and to try to get it through. But remember, everyone has to agree. Even those tax havens have to actually agree before something like this will actually happen. Yeah, so whether it happens or whether it doesn't, we don't know. But yeah, very fascinating. Something that was recent that just came up. Obviously, the America, in terms of time, they're like 6 hours or 8 hours or 9 hours behind, depending on where you are in America. But yeah, so yesterday, obviously, while we were sleeping, or while we were enjoying our evenings, America was obviously running. Okay, while we're in the evening, they're in the day, and this was something that came out in terms of news. That's quite fascinating. Yeah, so things like this you should be kind of like looking out for, and that's why even though you're doing TAX2601 and it's quite specific, it's always nice to try look at real world things, because that's what education's all about. A lot of the stuff that you study at university, yes, some of it you might use, but a lot of it you don't. But you need to like take what you can from all your subjects and then apply it as best as you can. So we've spoken about tax and what tax is and how countries across the world tax different businesses, people, etc. And we spoke about different systems of tax like progressive, regressive, proportional, etc. So it's always nice just to like read and see these things in action because yes, it might not affect us because we're not very, very big companies, but obviously this is going to impact the world if it does happen, if it does go through. And obviously things will be affected, okay, indirectly or directly. Okay, yeah, so I don't want to digress too much, but I'm just trying to show you a few like interesting things that have come up recently that relate to tax specifically. And it all comes down to what we spoke about last week, income, and whether you're a resident or a non-resident. Right, so whether you're a resident or a non-resident, it's not going to matter if they've got this global tax. Okay, because then the place of effective management is actually not really important, or even operations not really important, because you could have started your company in a tax haven, Isle of Man. Okay, and let's say you started a company in that country, and obviously you've been enjoying zero tax haven. But now that's going to change. Okay, so even though you're operating in a country like that, where they have very favorable tax laws, if something like this gets passed through like global regulation and it becomes like, it becomes, they call them, what do they call them? I think they call them accords, if I'm not mistaken. It's like a global agreement, or just even the word agreement is right. Even that's fine, like a global agreement where you hear countries signing an agreement. Okay, I don't know if you've seen some of that. Okay, you have like the US signing an agreement with China or signing an agreement with Iran or whoever. Okay, and those agreements are global like agreements or contracts inverted commas between countries. Okay, not between like taxpayers or companies. All right, y'all. So yeah, quite interesting. We still need to see what happens. Okay, is that all right? Did I overdo it there?
Yes.
Okay.
No.
All right,
It's fine.
great. Okay, so when looking at Tax 2601, the focus here, Chapter 4 or Study Unit 4, income. This week, we're looking at deductions allowances. Okay, but it all fits together. And that's the nice thing about UNISA's study guide is they break it up quite good in terms of the study units. So this is Unit 4, this is Unit 5. Okay, Unit 6 will be capital allowances, and then Unit 7 is capital gain. Okay, so we're looking at deductions and then allowances. Today, we're focusing more on the deductions and less on the allowances because you get other allowances that are capital allowances, and that's a separate chapter. Right, but after you've covered all the units, you've covered this whole thing. Okay, then you've got a very, very, very good idea of how companies, individuals, basically everyone is taxed. They're always taxed according to a specific calculation. And the calculation is based on this figure, not that figure. That figure will be updated to get a taxable figure. The taxable income is what you're trying to work out because that will be subject to tax. Does that make sense?
Yes.
Okay. Right, so last week we spoke about gross income. Again, just highlighting how important it is to remember what income is, because once you've got that, then you need to apply the basic deductions. Okay, they call it general deductions, and any special inclusions or exemptions depending on what you've got. Okay, so recap from last week, we spoke about this. We covered this slide actually. Let me ask you about this. What's the relevance of case law? Why are cases so important?
Because I remember something about interpretation.
Yes, and what's the law? What's the rule of law? What do they use? What do lawyers use? What do SARS use? What do the courts use? Say that again?
Is it the law of precedence?
Yes, very good. Okay,
Precedence?
precedent.
That would you.
Yeah, so in other words, anything that happens in the past will have bearing on the future. Does that make sense?
Yes.
Okay, and there are certain tests that you can apply, and then we looked at those tests last week. The same thing applies here, lots and lots of cases. And the reason for that is because, remember, companies want to deduct as much as they can. Sometimes companies even take SARS to court to try and motivate why they should be allowed to deduct something from their taxes. Okay, because if you're looking at this, if you're earning, let's just keep the figures very, very big. Let's say you're earning income, okay, as a large company, 100 million plus. Okay, we just keep it 100 million, all right? Let's assume, okay, that tax is applicable, okay, 28% in South Africa. And how much tax is this company actually going to pay? 28 million. If you're a large company, are you going to be happy paying 28 million of your 100 million to SARS?
No.
Probably not. Okay, that's a lot to pay over to SARS. SARS would love that, okay, but companies don't want to pay more, they want to pay less. So the only way they can reduce this liability is if they can find deductions and allowances that they can make use of. Right, so deductions, things that they allow you to remove. Okay, so you might have a company that makes 100 million. Let's assume, inverted commas, that they have 100 million in deductions and allowances, which is possible actually. Okay, you'll see with allowances, you can actually get lots and lots and lots of allowances in certain situations if you meet certain criteria. Okay, in other words, SBC. Okay, if you're an SBC, you get nice accelerated allowances that could actually effectively get you to pay zero because income is 100 million, deductions and allowances is 100 million. You're going to have 100 here, you're going to have 100 here, obviously negative, and then you're going to have 0 there and 0 there, and then 0 at the bottom. Is that good or bad for the receiver of revenue?
Good.
It's bad. Okay, the receiver of revenue doesn't want you to pay no tax.
Oh, okay.
Okay, so they don't really want you to. So I'm trying to highlight that whole burden of proof again. Okay, where you have a debate, a dispute. So SARS is going to say, no, you can't deduct that. No, you can't deduct that. No, you can't deduct that. But what happens if they say, no, you can't deduct that, but you don't agree? What do? You take them to court. Does that make sense?
Yes.
And in the court will establish whether you can or whether you can't deduct what you wanted to. Right? And that's why when looking at this chapter, case law is very, very important again. And you'll see some of them come up in different scenarios. We're also going to be looking at trading stock. Okay, so what happens if you're buying and selling goods, okay, and you've still got stock on hand? Okay, are you able to still deduct a portion of it? Okay, and how much can you deduct? In other words, your costs. Okay, so we'll look at the definition. The general deduction formula is very, very important. That they ask in almost every assessment. Okay, it's normally theory, right? And they take you through the general deduction. In the general deduction formula, you have certain criteria that needs to be met. Okay, if you meet all the criteria, then SARS will allow you to deduct amounts that were paid, okay, or incurred for specific purposes. Right, we'll look at calculating the specific deductions. Okay, we'll be looking at prohibited deductions and we'll be looking at trading stock provisions. Okay, that's everything that we need to look at in terms of learning outcomes. All right, so just to get us started, just to get you thinking about this, let's call it a topic, how do companies generate profits?
Either by services or by selling goods.
Good. Okay, yes, you get trading entities and you get service entities. So to generate a profit, what do you need to do?
What do you mean? Like you need to work or you
Yes.
need to.
So
Okay.
maybe you've heard of this expression. You need money to make money, or you need money. Yeah, you need to invest to get some sort of return. So you need not always, but this is just a phrase that's used. So in business, sometimes you have to put in money to get money out. If that doesn't make sense.
Yes.
I forget the exact phrase, but there's a phrase about that. There's a phrase that kind of relates to that. Okay, you need money to make money, basically. So if you have a company that is going to be generating a profit, either through sales or through services, to render the service or to sell something, you obviously would have had to have paid for something. In other words, expenses. Does it make sense?
Yes.
Okay, so how do you calculate profits?
Income minus expenses.
Correct. Income minus expenses. That's the accounting way of working out or calculating performance. Okay, accountants can measure performance by looking at your profits. Okay, obviously the profit is going to be taxed. All right, so when looking at tax, those expenses, some of them can be viewed as being deductible. Deductible meaning I can actually subtract that from my income. Because as we said, to generate profit, you're going to need certain expenses. You're going to have to pay for water. You're going to have to pay for labor. You're going to have to pay for electricity. You're going to have to pay for rent, etc., etc. Okay, those are things that you're paying in order to generate or create the profits. Right, so SARS isn't unreasonable. Okay, do those items benefit the company?
Sorry, what? What did you say, Anthony?
Do those
What is
items,
the
those
question?
expenses, do those expenses benefit the company?
What do you mean benefit? Because you need it,
Yes, that's exactly it. So
but it
keep
does
going.
take away from your profit.
Yeah. Okay. In other
So you
words,
need it,
it's
but it takes away from your profit.
yeah, it's part of
Yes.
operations. Do you agree? Okay,
Yes.
but spending money on the right things in the company is going to hopefully help the company. Does it make sense? So, for example,
Yes.
I can do marketing. I can pay someone to hand out pamphlets. I can pay someone to do social media. I can pay someone to whatever, and that's part of marketing. Okay, what benefit can the company get other than that? In other words, other than just the marketing, they can also get a deduction. Right. So if you're a business, if you're a registered entity, okay, a company perhaps, okay, it could be a private company, public company, whatever. What benefit do you have in terms of being able to claim something from SARS? Well, as long as it's business related, as long as it relates to the operations of the business, SARS will say, well, because you've used money to make money, we're going to give you the benefits. So in other words, all the money that you used, we're going to give that to you as a deduction. Right? Do you see the fairness of that? Okay, so in other words, SARS is not taxing you on everything. Effectively, SARS is
Yes.
taxing you on the
So
difference.
do all expenses.
So you broke up there. Can you repeat?
So then they'll deduct all of the. So they'll deduct all of the expenses and then tax you.
Okay, when you say all of your expenses, that's where Chapter 5 comes into it. Okay, SARS doesn't
Oh,
allow you to deduct all your expenses. They only allow you to
okay.
deduct the business expenses. Does that make sense?
Yes.
Okay, and that's what SARS is going to use to process these deductions. Okay, they're only using rules and regulations that are in line with a particular company, but in line with the rule of law. Okay, so in other words, they're not going to allow you to deduct everything. Okay, they're only going to allow you to deduct certain things because it needs to be a fair system. But if you've used money to make money, then they're going to allow you to deduct that from the revenue. So effectively, as you said, they're only taxing you on the difference, which is ultimately the profit. That's what they actually want to tax. They want to tax the benefit that you derive. They don't want to tax your day-to-day ongoing operations, if that makes sense. But from a deduction point of view, for a taxable income point of view. Are we okay?
Yes.
Okay, I see the connection's a little bit delayed today. Are you using a different connection today? Are you in a different place today? I see it is a bit delayed. It's normally a bit better. I don't know if it's yours or if it's mine. It could be mine. Let me check.
No, I'm using the exact thing.
Sorry, I didn't get that. Say that again.
Can you hear me now?
Yes, I can.
Okay.
Are you using a different connection or the same one?
The exact same
Oh,
one.
the exact same. Okay, so maybe it's my side. Maybe it's the gloominess of the weather. I don't know. Maybe that's affecting the airwaves. I don't know. Okay, but it seems to be okay. I can hear you, but just there's a bit of a delay in between like question and answer, but it's not a problem. There's more questions here, so I'm going to leave you to answer these. What system companies need to follow? Any idea? This we've actually spoken about.
Like Anthony,
Yes?
like systems that we used in accounting, because I know one has stock take and
Ah, okay, you're thinking about that type of system. You're not wrong. That's actually quite a good way of looking at it. If you're looking at
and then one
systems,
is like, I know one is when you sell cars. What are they called? Did you know what I'm talking about?
cash and accrual, cash versus
Okay,
accrual,
that makes sense.
cash versus accrual. Do you remember that? Accounting.
Yes,
Okay,
yes,
accountants use IFRS. SARS uses what? Income Tax Act. Do you remember that?
yes.
Okay, so when you're looking at the system, you're going to focus on obviously tax. Okay, so just because you get to subtract something because of IFRS, so for example, okay, entertainment is a good one. Okay, if you're paying for entertainment, so let's assume refreshments. You're buying refreshments for the office. Do you think SARS will allow you to subtract that or deduct that? What do you think?
Or if you're buying refreshments for the office, I don't know. I have no idea. Because it is an
Okay,
expense, but it's not like important. It's not an operating expense,
exactly. That's perfect.
but
What
it
you
is an
said there hits
expense.
the nail on the head. Okay, accountants just look at the impact on the transaction on the business. Does that make sense? Okay, SARS looks at more the
Yes.
purpose. So they'll say because it's entertainment, we're not going to allow you to deduct it because it's prohibited. Okay, because SARS wants companies to not spend more on entertainment. They want companies to spend more on growth. Okay, so buy more assets to grow the business. Maybe hire more staff to grow the business. Okay, if I pay staff a salary, that I can deduct. Okay, if I pay for staff refreshments, I can't deduct that because it's not business related. Okay, so as you put it, it needs
Okay.
to relate to business. It has to be part of trading. Okay, they're called trading deductions. In other words, you're doing something. You're buying and selling, or you're providing a service. Okay, the important bit that you need to remember is that anything that's being used for business purposes, there's a very, very, very high likelihood that it could be deductible. Okay, so do the systems differ? Yes, they do. Okay, obviously accountants use either the accrual system or the cash system. Right, from a SARS point of view, SARS will be using the tax rules. Right, and that's why sometimes you can have certain adjustments that can be considered. And sometimes those adjustments can be a benefit to the business. In other words, they reduce, okay, they deduct a certain amount from your taxable income, or they can be the opposite, and they don't allow you to deduct it, and then you don't get that benefit. Okay, so the differences between the systems relate to operations. Okay, is it more business related or is it more personal related? If it's personal, it'll never, ever, 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 ever be deductible. Okay, personal amounts, okay, that are used to provide for personal events or activities or whatever the case might be, those aren't deductible. Okay, it must be for business purposes. If it's for business, then it's deductible. All right, still with me? Does that make sense?
Yes.
Okay. All right, there's the slide. I've highlighted the focus for study unit 5. Study unit 5, this is exactly what we're going to be looking at. That line item. Okay, less deductions and allowances. Obviously, businesses like this a lot because you're going to be subtracting, you're not going to be adding. And if you're subtracting, taxable income will obviously decrease with more deductions or with more allowances. Make sense?
Yes.
Okay, so answer this question for us. Why do taxpayers want deductions?
So they pay less tax.
Yes, by reducing what?
The taxable income.
100%. Right, so how do we know what's deductible and what's not? Right, so notice here. Notice how SARS operates. SARS, they're not going to give you a list of everything that is deductible. Okay? They're going to give you criteria that must be met in order for something to be deductible. Okay, because do you agree there's probably millions of different businesses out there, right? Do you agree?
Yes.
And those businesses could be doing, for example, let's assume you're selling sweets.
Okay.
Okay, let's say you're Lindt. Okay, you're selling chocolates. Okay, we just had Easter. I don't know if you celebrate Easter. Maybe you follow a different religion, or if it's maybe like, I think, is Holly also this time of the year?
I have no idea. I'm Christian.
Okay. Oh, okay. So you do celebrate Easter. Okay, so that was
Yes.
fine. That's a good example. Okay, so we just had the Easter weekend. Okay, obviously Lindt would have had chocolates and they would have sold chocolate. Okay, so obviously if Lindt is buying and selling chocolate, would they be able to deduct that as part of their inventory?
Yes.
Definitely. So anything that goes into making chocolate will be deductible. But let's assume we're running let's assume we're a pilot. Okay, and we're SAA. Is SAA going to be buying chocolates? They could, but if they do buy chocolate, they might buy chocolate to, I don't know, give the pilots energy so they don't fall asleep. Okay, I'm just using that as a random example. Okay, and let's assume they do buy chocolate, but they give chocolate to their staff, and it's kept in the staff room, and it's kept in the what do they call it, the canteen, the cafeteria. Okay, in the canteen, in the cafeteria, where the staff rest and relax. Okay, there's sweets or there's chocolates around. Okay, and maybe they even gave staff some of that because of the Easter weekend. Okay, if that's the case, do you think SARS is going to allow SA to deduct the chocolate that they bought for the pilots and the staff?
Yeah.
Definitely not. Okay, and the reason why is because it doesn't meet the criteria. Okay, and that's why I'm trying to explain that SARS goes with a formula rather than a list. Okay, they're not going to give a list because a list might be deductible in certain situations. For example, if a bakery buys chocolate and they're making maybe chocolate flavored something, okay, cakes, savory breads, whatever, or sweet breads, whatever the case might be. Okay, if it's a bakery, obviously chocolate might be deductible. Same for a chocolate making company, but not for other companies. Okay, so do you see that they don't make a list? Because if they make a list, that list needs to be very, very, very specific, and it needs to cover every single business that's out there. Does it make sense?
Yes.
Okay, so they don't do that. What they do is they give you a guideline. Okay, and the guidelines are as follows. Certain expenses may be claimed as an allowable deduction if expenditure and losses are deductible under Section 11A. Section 11A comes from the Income Tax Act. Okay, that's where you'll find it in terms of legislation. Okay, legislation says under Section 11A that for something to be deductible, the expenditure and losses must be actually incurred. Okay, actually incurred. Actually incurred relates to accounting. Okay, so not something that you want to do, something that you've done. Okay, you've actually incurred it. Okay, you've incurred the costs. Okay, you've paid the costs. It's incurred. Okay, does that make sense?
Yes.
Okay, so maybe you're Lindt Chocolate or you're a bakery and you want to buy chocolates, but you haven't bought chocolates. Because you haven't bought chocolates, it hasn't been incurred. Okay, maybe if you've ordered chocolates, but you're waiting for the delivery, so you haven't received it. Have you incurred something? Yes, you have. Okay, you have been invoiced, you've placed an order, you're waiting for delivery. Whether you have the chocolate or whether you don't, you've still incurred an expense. Does that make sense?
Yes.
Okay, that's important to note. Okay, because when you get theory questions, they're going to be asking you about these things. Okay, I've seen lots of questions where they've also asked you to debate whether something is deductible or not based on the criteria. Okay, and that's what you'll do. You'll write down these 5 bullets and then you'll talk to each of them separately. And you'll say, does it apply to the case study? Yes or no? Okay, and you're obviously drawing conclusions from the case study, okay, depending on how much information they give you. All right, so that's the first bit. Remember we said case law is important? So there's the case, the Edgar Store case. Okay, the Edgar Store case was dealing with this, actually incurred. Okay, it relates to the accrual bias. Right, so the accounting treatment is important. Either incurred or earned. It doesn't have to be received or paid, in other words, cash flow. Okay, as long as it's incurred. If it's incurred, there will be a deduction, potentially, depending on whether those deductions are allowable or not. Okay, does that make sense?
Yes.
Okay, so we're always going to be looking at the accrual basis. Right? And then you'll see later on, we get to something called the prepayment. Prepaid expenses. That you know from, not economics, accounting.
Okay.
Okay, so in accounting, you learnt about a prepaid expense. What happens if I pay for an expense ahead of time? Okay, has it actually been incurred? That's the big question mark. Okay, sometimes it has, sometimes it hasn't. If you're prepaying stuff, a prepaid expense falls outside of the scope of the general deduction. Okay, a prepaid expense will fall under a special deduction. And that's what we'll look at later. Okay, so the point I'm trying to make with this example is if you get one thing wrong, so in other words, this is wrong, this is right, this is right, this is right, this is right, SARS will say sorry. Okay, you cannot deduct it. Right, you have to meet all the criteria. Section 11A means I have to meet everything. Tick, 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 tick. If I can tick everything, then they'll allow me to deduct it. Happy with that? Does that make sense?
Yes.
Okay. Next part of the definition. It must be during the year of assessment. Right, very similar to what I spoke about, a prepaid expense. If you pay for something ahead of time, okay, it's not during the tax year. It relates to the next tax year. Would you agree with that?
Yes.
Okay, so will that meet the definition of a general deduction? No, it won't. Okay, if I've prepaid for something, it's not during the year of assessment, it's outside. It's for the next year of assessment. Okay, so general deduction won't apply, but then you might have a special deduction that will apply. Okay, and those are things that you'll see later on. Okay, the whole of chapter 5 looks at things that you can deduct, things that you can use to make your income, okay, your taxable income less, okay, smaller. Right, again, case law is important. I don't know if I've revealed this on your slides. If I haven't, then you just need to add it in. Okay, I don't know if you've printed your slides or if you're using it electronically, but I may or may not have revealed this. If it isn't revealed, then obviously you would have to add it to your notes. Okay, but yeah, just double check just to make sure. Right, during the year of assessment, we spoke about a year being how long?
A year being how long?
How long is a year in terms of tax and accounting?
Like how many days, or like do you want like the
Yeah,
timeline? So
12
1 month.
months. Yeah, the months.
Okay.
Okay, so March to February. Okay, 12 months.
Yes.
Financial year, 12 months. Tax year, 12 months. Okay, everything's 12 months here, but it must be during the year of assessment. Okay, so general deduction only applies if it's during the year of assessment. Make sense?
Yes.
Okay. Next one, it must be in the production of income. So in other words, it needs to be used somehow to produce income. Okay, so if I bought flour to bake cakes, okay, would the flour be considered in the production of income?
Yes.
Yes, it would. Let's assume I was renting out a factory to bake the cakes. Okay, the rent for that factory, would that be in the production of income?
Yes.
Yes, it would. Right, and that's very important. So when you look at this section, I've put a little note here, operating. Okay, operating. What case law am I going to use? I'm going to use the PE electric tramway case. Okay, what does that talk about? Okay, in that case, they spoke about this, an inevitable concomitant or the closely connected test. All right, so in other words, they're going to say, what are you doing? Okay, let's use the baking example. I'm a bakery. Okay, then they're going to say, what is an inevitable concomitant or a closely related test? Right, so in other words, if I bought flour, okay, is flour something that a bakery would need?
Yes.
Yes. Okay, you can't bake without flour. Okay, it's inevitable. It's part of the business. Okay, it's like let's say you were a delivery company. You're delivering goods. Okay, the fuel that you have to put in the delivery vehicle, would that be inevitable, concomitant, or closely connected? Yes. Okay, fuel that I use in the delivery vehicle can be deductible because that's a business expense. Does that make sense?
Yes.
Okay, so just remember, it must be in the production of income. So in other words, you're using that expense, whatever it is, and you're using it as part of the operations of the business. Okay, the word here in the let me change the color so I can actually write on here. Okay, the word here is important. It must be operating. It must be related to operations. If it's not related to operations, it's going to be very, 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 very difficult to actually get to the conclusion that it should be deducted. Okay, you can't deduct everything. You can only deduct things that meet the general formula. Okay, the general deduction formula. So far, so good?
Yes.
Perfect. Oh, why is it not clearing? Oh, no wonder. I'm using PowerPoint instead of Zoom. Okay. Next one. Ooh, I need to get the mouse button again back. Okay, next one. Not of a capital nature. Okay, remember last week we spoke about the tree and the fruit?
Yes.
Okay, so if I buy fertilizer for the trees, can I deduct that as an expense?
Yes.
Definitely. Okay, fertilizer would be considered not capital in nature. Okay, let's assume, I don't know, maybe I'm going to buy like barbed wire or something to protect the tree. Okay, and I'm going to secure it to the tree.
Here's a question though.
Yes, yeah.
Say for your asset, right, which would be capital. Okay, so say like you had a car and it was for the business, and the maintenance on that car, you would be able to subtract it from expenses, right?
Yes, okay, because remember, the maintenance of the car could be seen as production of income. But the big question is,
Okay.
what car?
No. It's purely capital. You're not selling cars or anything like
Yes,
that.
no, I understand that. But the reason why I'm
Okay.
saying what car is it a car that you're using for delivery, or is it a car that the manager is using as a fringe benefit?
No, for production.
Yes,
Was the
okay,
car was
yeah.
asking.
So capital in nature is the whole tree and fruit concept again, and it must be production of income. Okay, if it's not producing income, in other words, if it's not the delivery vehicle, if it's not a delivery vehicle, they're not going to allow you to deduct it. Okay, and
Okay.
I don't want to go into too much detail, but certain vehicles, SARS considers passenger vehicles, and certain vehicles are considered commercial. Okay, if it's a
Okay.
commercial vehicle, then SARS will say definitely. Okay, anything related to the commercial vehicle, it's deductible. Right, but if you're buying a passenger vehicle, which is seen more as recreational, SARS might say no, you can't deduct it. Then you've got to prove it. Then the burden of proof relies on you. Okay, let's say you're an Uber driver. Okay, obviously you're not going to buy a bus to be an Uber driver. Does that make sense? You're going to buy a normal vehicle. Do you agree?
Yes.
Okay, so if you buy a normal vehicle and you're delivering, well, not delivering, delivery is not the right word. You're transporting passengers, okay, you could maybe say, well, it's production of income and it's not capital in nature because I'm not selling the car, I'm using the car. But again, it comes down to whether SARS will allow you or whether they will not. Okay, so it's the whole capital versus revenue debate. Does that make sense?
Yes.
Okay. Right. Always go with capital rather than revenue. Okay. Capital is better because you don't pay as much tax. Revenue or income, you pay a lot more tax. Right. So ideally, you don't want it to be. Oops, sorry. I knocked this over. Okay. You don't want it to be income. You want it to be capital. Okay. What tax do you pay on capital things? Capital gains tax that you don't know yet. We've touched on it like right at the beginning where you looked at different types of taxes that you'll only cover in I think chapter 7 or chapter 8, the last one. Okay, is that all right? That's a good question.
Yes.
Okay, there's always a question mark. That's why when you started the course, we spoke about the dispute resolution process because disputes can arise. Okay, you can argue with SARS and you can say, well, no, this is definitely business. It's not recreational. It's not private. It's not personal. Okay, if it's a personal expense, you'll never be able to deduct it. If it's a business expense, then you can deduct it. But again, it comes down to motivation. And sometimes it comes down to the court. Okay, the courts will decide what is and isn't allowed. Does that make sense?
Yes.
Perfect. Okay, so if I just remove all the writing here and just reveal what I have at the bottom. Okay, case law wise, what's capital, what's revenue? The case that you can mention if this is a theory question, new state areas case. Okay, what did that case do? The case established what expenses were not capital in nature. Okay, it comes down to what we spoke about previously, an enduring benefit. Okay, I think that even came up in the actual case. Okay, it's been a while since I've looked at those cases, but yeah. The words I can remember is enduring benefit. Here's it here. There, next page. On the next page, there's it there. Biggest consideration, enduring benefit. Operations versus structure. Okay, tree versus the fruits. Okay, remember that.
Yes.
Okay, the tree and the fruit principle, very important, but that's for income. Now we're not looking at income, we're looking at expenses. Right, so what expenses are operational or what expenses are structural? Okay, so if I'm putting in fertilizer, okay, if I'm buying fertilizer, the fertilizer that I'm putting in the soil would be operational. Okay, structural. Structural means I've reinforced this tree, or let's say I've built something around the tree to support the tree. Okay, that's structural. That's capital in nature. Okay, you're not going to be able to deduct that. Does that make sense?
Yes.
Okay, and then the last one, it must be laid out or expended for the purposes of a trade. Right, so again, SARS is going to look at your business. Okay, there's an eye. Okay, little eyelashes there. We'll make it a girl's eye. Okay, so that eye, okay, assuming SARS is going to be looking at the business. SARS is going to look at that business and they're going to want to know, was it expended for the purposes of a trade? In other words, what business are you running? Okay, it comes back to what I said earlier. Okay, SARS is using a generic formula. They're not giving you a list because, for example, if you're SAA versus a bakery versus a chocolate company versus a law firm, okay, versus an accounting firm, okay, every business is unique. Every business is different. As long as it's laid out or expended for the purposes of a trade, right? So in other words, if SAA had to spend money on certain expenses because of their planes, okay, obviously they're going to allow that as a deduction. Okay, if the business is a bakery, okay, and you're, buying stuff that you're going to be using, okay, to bake something in the oven, okay, right, the oven would be capital. Okay, if it's the rent or the water and electricity, okay, the water and lights, okay, you need water and lights to run a bakery. Okay, the water and lights that you're running for the bakery would be expended or laid out for the purposes of a trade. Okay, if it's a law firm, same thing applies. Okay, what does the firm actually require that must be laid out or expended for the purposes of a trade? In other words, what do law firms actually need? What does SAA actually need? What does a bakery actually need? Okay, does that make sense?
Yes.
Okay, a lot of this sounds quite logical, but you'll see when they give you a scenario, it's quite tricky to relate it to the scenario because sometimes it's not so obvious. So you just need to think about these cases. Okay, there's another case here, the Burgess case. Okay, what happened in the Burgess case? They spoke about what determines this, trading activities. Okay, it went to court. There was obviously a dispute, and ultimately the courts decided to rule in favor of either the plaintiff or the defendant, but it was based on the trading activities. In other words, what was their purpose? Okay, SAA can, maybe some of them, maybe not the best of example, but let's assume SAA had a kitchen. Okay, and now we're going to be buying flour so we can bake some bread in the kitchen. Okay, maybe we're going to give that bread out at a function, whatever the case might be. Okay, it's not laid out or expended for the purposes of a trade. Okay, but let's assume in that kitchen you're baking bread and sandwiches to give the passengers on the plane. Okay, would you be able to deduct that?
No.
Yes, it's purposes of a trade. Okay, you've got to give passengers something to eat. That you could motivate as possibly being part of, expended or laid out for
But
the
that's
purpose of a
not
trade.
that's not like but that doesn't make SAA run though.
True, but it's still part of operations. You could possibly say it's in the production of income potentially. Ideally, I doubt SAA would do that. They would probably just outsource it because why would they create a whole kitchen just for that? Okay, it probably doesn't apply. They would outsource it. But I'm just using it as an example. Okay. Remember, these things can be taken to court. Let's assume SA is going to take that in house. Let's assume they don't want to use third parties. Let's say third parties are too expensive. Why should we pay someone else to make food for our planes? Why can't we make our own food and why don't we label it SAA? Let's call it SAA beef or chicken. Okay, so let's assume SAA is they're going to raise their own cattle, they're going to raise their own chickens, and they're going to process the chicken, and they're going to make sandwiches, and they're going to give it out on their airplanes. Okay, if SAA actually decides to buy a factory and make these things themselves, okay, and it's for the purposes of income, in other words, it's to run the business, then that would be deductible. Okay, if SARS says no, it's not, then what could you do? Take them to court. Then the courts will look at that. Question mark, question mark, question mark. The courts will decide whether it's actually a trading activity or not. Okay, does that make sense?
Yeah.
Okay, even like those airport lounges. Okay, maybe you have an SAA airport lounge. Okay, but remember it's normally branded by other companies. So for example, maybe you have like a bank. Okay, banks often do it. Okay, depending on which
Yeah.
bank you do, bank you bank with. Sometimes they give you those airport lounge access to those nice airport lounges. Okay, obviously it doesn't belong to SAA, it belongs to the bank. Okay, would you say that the bank would be allowed to deduct the expenses at that lounge? So, for example, they're probably going to have to pay rent. Okay, they're probably going to have to pay water and electricity. Okay, would that bank be allowed to deduct those expenses for that product or that service? What do you think? If you were SARS, what would you say?
Okay, so now I get what you mean because in one breath it's like it's not their core business, so it doesn't go under operations,
Exactly.
but it does bring more clients
Yes. Okay. So do you
as a
see?
perk.
Yeah. Do you see where the debate comes into? Do you see where we go to
Yes,
court? Because there could be a dispute. SARS might say no. Banks shouldn't have airport lounges, but then the bank could say, well, the airport lounge is part of the benefits of having a specific account with the client. And if we
yes,
didn't have those benefits, the client would go to a different bank. Does that make sense?
yes.
Yeah, so it's laid out or expended for the purposes of a trade. It wasn't in the production of income. So we're not building a new branch because if we're building a new branch, then that could be seen as production of income. It could be laid out or expended for the purposes of trade. So those two are quite closely linked. But again, there can always be disputes. There's always a question mark. And that's why you need to motivate and you need to explain, but it needs to be in line with those 5 criteria points. If you can motivate all 5, then the conclusion is going to be yes, deduct. Does that make sense?
Yes. So what would you do for this one? That example that you just gave me.
Yeah, well, again, it's a tricky example because you need to consider is this actually expended or like is it how closely related is it? So for example, if we go back to what we said here, where's it? Here. Okay, I would be looking at it as part of this. Is it an inevitable concomitant? Well, the bank will probably say yes. SARS will probably say no. SARS will say, well, you're a bank. Okay, you're not supposed to
Yes.
give all these benefits. Okay, when did giving people airport access or lounge access or benefits become part of the bank? Okay, now it's quite a common thing, but before maybe it wasn't. And that's why we're talking about law of precedent, because new things are created, businesses change, businesses develop, businesses evolve. So, for example, now everybody's doing everything online. Before, if you worked from home, you wouldn't have been able to claim anything. But now, because everyone's working at home, if you can prove that a certain portion of your expenses relate to your work, you can actually deduct that. But then, see, it might get taken to court. If SARS is not happy with that, then they're going to dispute it, and then there'll be burden of proof and etc. etc. And then who decides? The court will decide. So if you're asking me, what do I think about this situation? The answer would be, well, is there a case that motivates or substantiates whether they can or can't subtract that, or not subtract, deduct it? Okay, and then what we could do is we could maybe go look at the bank's financials, and we could see, do they mention anything like that, or is there an expense line item that relates to that? And then we could do some investigation. Or we could go to SARS and we could look at a practice note. Okay, and that's where all those things come into it. Practice notes, interpretation notes, case law. All of that stuff relates to things that haven't been covered yet but have gone to court. Okay, so obviously these are benefits that are being provided by a bank. If the bank can motivate and if they meet all the criteria and SARS is happy with the motivation and they don't dispute it, then it's fine, then they can deduct it. But as long as one of them are no, if SARS says no to that or no to that, all right, and the bank is not happy with that, then the bank can take it to court. Okay, and then the courts will decide. Right, so I don't have an answer for that question. I don't know if banks are allowed to deduct those benefits or not. Okay, my initial impression, okay, my gut feeling would be, well, if they can motivate that it's specific to the client's account. So in other words, it's part of the actual account. It's like it's built in. It's part of the account. So you buy something and this is what you get. Okay, you get all these benefits. Then you could motivate it as being production of income, purposes of a trade. Okay, and then you could potentially deduct it. Okay, but again, so I think airport lounges, my gut feeling is yes, they can deduct that. So all those banks that have airport lounges that people can use, banks will obviously generate or provide them with that service because it's obviously going to be deductible. Okay, from a tax point of view, because it's part of the operations. Okay, or seen as. Okay, if it wasn't deductible, I don't think banks would have done it. Okay, because then it's not much of a benefit. Then it's purely client retention. Okay, and it's more like a want than a need, if that makes sense. Okay, so my feeling around that question would be it is deductible. Okay, banks have probably viewed it as that, and SARS has agreed, and then they've provided those products or services. Okay, that's my initial feeling, because most of the banks do provide you with that service, but only for certain types of accounts. Right? And that's why you pay more for those accounts. The fees are higher because they need to cover those costs. Right? And because they're covering those costs, it's part of their expenses. So yeah, from a tax point of view, it could be questionable, okay, whether they can or can't deduct it. It all depends on whether they can motivate it being production of income or expended or laid out for the purposes of a trade. Okay, because it's a trade, because banks have become a certain, let's say, type of business where banks do often provide you with certain benefits. To me, it could be seen as part of the trade. Okay, because it's not. They're not selling anything. So, for example, when you go to those airport lounges, you don't pay to go to the lounge. Okay, and if you're a client, okay, you have a certain amount of visits free. Okay, you can use that whenever you go to the airport. Okay, it's not something you're paying for. So the bank isn't making money from it. Okay, they're not earning anything from it. It's probably indirectly covered by fees, but that's a whole separate source of income to cover the costs. Okay, but I mean, they're not charging you. They don't charge you for every cup of coffee you're drinking, or they don't charge you for every bottle of water that you drink, or food that you eat, and that type of thing. Does that make sense?
Yeah.
Okay, it's purely like an additional benefit, and it's built into the product. So because it's built into the product, I would say that yes, it's part of this or it's part of that, and SARS will probably allow them to deduct it. Okay, but again, it's still questionable, okay, because it needs to be allowed by SARS. Okay, the only person that can actually answer that question for us would be SARS. Okay, SARS would answer that question. So if we were the bank, okay, we would consult with SARS. We would find out from SARS either through a practice note or through SARS directly. Okay, we would contact SARS and we would ask them, okay, this is the situation. This is what we're doing. What do you suggest? Okay, and then once we know, then we just implement it and we just apply it. Yeah. Okay. Does that make sense? So with theory questions, you will be given scenarios like that, but scenarios that are quite obvious, not so questionable.
Okay.
Okay. All right, and that's pretty much it in terms of the definition. We've covered all of that. The last bit that we need to look at is this. Let me just close that. Considerations. If an expense is not deductible according to the general deduction formula, can it still be deducted? What do you think? So in other words, not deductible in terms of section 11A, general deduction. Can it still be deducted?
No.
Okay, the answer is actually yes. But, and there's a big but, it must be a SARS tax concession. Okay, so here's a simple example. Okay, entertainment. Okay, SARS, and they clearly express this. It is actually part of the prohibited deductions. SARS doesn't want you to spend money on entertainment, especially a business. A business shouldn't waste their resources on entertainment. So SARS says, no, you cannot. You cannot, you will not, and you will never be able to claim any of your entertainment expenses as a deduction. But, and there's a very big but here, it's a big but. Okay, a big but. Okay, but if you can prove that you have to entertain your clients, in other words, maybe you've got to take them out for lunch, okay, and it's a business related expenses, and you can prove that it's business only, then you've got to apply to SARS for a concession, and then they might say, well, fine, okay, in your situation, okay, we will allow you to deduct maybe a percentage of. They won't allow you to deduct all of it. They might say, okay, well, 50%. Okay, both of you are eating at the restaurant. Okay, you can't deduct your food, but you can deduct your clients. Okay, because it's the client that you're entertaining. Okay, then they might end up saying that, and they might give you a concession. And if they give you a concession, great, then you just follow it, and then you apply it. Okay, so the answer here is yes. And what do we call those things? Well, concessions, but something else that we're going to be looking at is a special deduction. Okay, a special deduction is something that SARS will allow you to deduct, even though they know it's not allowable in terms of Section 11A. Okay, so it doesn't meet general deduction, that falls flat, but they still allow you to deduct it as a special deduction. Right, so do any specific requirements need to be met before deductions are allowed? Yes, it must be business specific. Has to always be business. SARS will never ever allow personal, okay, or recreation. It'll always have to be the business. It must be business related. Okay, does that make sense?
Yes.
Okay, so here are some of the specific deductions. Okay, these are special. Special meaning they're not general deductions. Okay, and if you've gone through the textbook or even the study guide, they've probably given you references to the what do they call it? The legislation. Okay, because all of this is outlined in the Income Tax Act. Okay, so when I look at more specific questions, okay, when we get to past papers and the next assignment, okay, assignment 2, I will refer you to certain passages in the actual legislation, okay, or the textbook, either or. Okay, the textbook's actually better because they summarize it all for you. Then you don't have to go find it. Okay, but because we don't have a textbook, and I'm not buying a new textbook every time someone does this course, I'm just using my old textbook just to reference it. Okay, if there's anything new, then I will refer to the actual legislation. Okay, and that I'll show you from the actual SARS website or from the actual Income Tax Act. Okay, so legal expenses. Okay, are legal expenses, do they meet the general deduction? Actually incurred? Yes. During the year of assessment? Yes. In the production of income? No. Capital nature? No. Later for the or expended for the purpose of a trade? No. Okay. Companies aren't going to be paying legal expenses as part of production. Okay, you don't pay a lawyer to produce income. Okay, the same thing with laying out or expended for the purposes of a trade. Okay, here we're talking about legal expenses when a company gets sued, maybe. Okay, if you get sued, okay, you can't claim that's a general deduction. Okay, it's a legal expense, it's a special deduction. Do you see that?
Yes.
Okay, so what does SARS say? SARS says legal expenses will not meet this general deduction. It falls flat. Okay, so what are they going to say? They're going to say, well, we understand that companies have lots of legal expenses because companies do have to pay for certain things in terms of compliance, etc., etc. Okay, and what will SARS say? SARS will say, well, we understand that many businesses have lots and lots and lots and lots and lots of legal expenses. So we will allow them to claim a portion of it or all of it as a special deduction, okay, based on the legislation. Right, so these are some of the special deductions. Same with the restraint of trade. Okay, a restraint of trade means it's an expense. Okay, you're paying an employee to not go work from a competitor. Does that make sense?
Yes.
Okay, what is SARS going to say? SARS is going to say, actually incurred? Yes. Year of assessment? Yes. Production of income? No. Okay, you're paying someone not to work. You're paying someone not to be part of the business. That doesn't make any sense. Okay, it's not production of income. It's definitely not let out expense for the purpose of a trade. So they'll say it does not meet the general deduction formula. But what will SARS say? SARS will say we understand that many companies have to protect their trade secrets, and a restraint of trade is quite a common occurrence as an expense. All of these things on this list are expenses, things that you're paying. Businesses have to pay legal expenses. Businesses have to pay restraints of trade. Businesses have to pay for patents, copyrights, designs, trademarks. Okay, copyrights, designs, and trademarks, those are capital in nature. Do you agree? It's not everyday income. It's like a patent, it's a design, it's a copyright. That copyright, that patent can last for 50 years maybe, 100 years maybe, depending. Do you agree?
Yes.
Okay, so do you see? I'm just trying to highlight a few of them. A lot of these don't, or all of them actually, I should say, all of them don't meet the general deduction formula. Section 11A, it does not meet the general deduction. So you'll never ever put this under Section 11A. It'll always fall under a different section. Okay, and these are specific sections in the actual act. Okay, you've got like 11. You've got more than 11A. You've got B, you've got C, or you've got all these other ones. Okay, and you might even have other sections. Section 12. Section 12 is the capital allowance. That's something completely different. Okay, that you'll look at in another topic. Okay, but the point is, all of these specific deductions are good. Why are they good?
Because they lower your tax, your
Exactly.
taxable.
Okay, all companies want these. Why? Because they're so good. Does that make sense?
Yes.
Okay, they're very good. You want to deduct as much of this as you can. Okay, which company wouldn't want to do that? Does that make sense?
Yes.
Okay, so all of these things are good, and these are the things that you need to look out for in an exam. Okay, the ones that they like testing, this one. This one comes up a lot. Registration and acquisition of patents, copyrights, designs, and trademarks. Okay, when we get to examples, we'll look at it. Just to summarize, if it's less than 5,000, you can deduct the full amount. If it's more than 5,000, and if it's a copyright, 5% only. If it's a design, 10% only. Okay. Research and development, bad debts and credit losses and provision. This one's also popular. That one you'll see quite a bit in past papers. Employer contributions to the employee pension fund or provident fund, donations to a PBO, annuities to former employees, prepaid expenses, also popular one. Okay, those three I see a lot, okay, in past papers. You might see one or two of the other ones, okay, here and there, different questions, different years, different examiners, but the ones that I've highlighted, almost every paper I've seen always has those three, and then we'll look at them in more detail. All right, so these are things that I can specifically deduct that they will allow me to deduct. SARS is telling me these things don't meet the general deduction. We know that, but we're still going to allow you to deduct it. That's how nice they are. Does that make sense?
Yes.
Okay, and which company wouldn't want this because it's going to reduce their taxable income? And that's what we said earlier. We said companies don't want to pay more, they want to pay less. So that's why we're going to use all of these things. Okay, where I have brackets, I'm just showing some of the summarized notes. So if it's a provision, limited to 25%. Employee contributions, limited to 10%. Donations, 10%. If it's prepaid expenses, if it's less than 6 months, or if it's less than 100,000, you can claim all of it as a deduction, even if it relates to further on. Okay, as long as it's less than 6 months, so it's prepaid, but prepaid for 6 months, not prepaid for 12 months. Okay, it could be prepaid for 12 months, then it's more than 6 months. But if it's less than 100,000, they'll still allow you to deduct it. Okay, so there are certain, let's call them considerations. Okay, and these are quite specific. Right, we'll look at these in more detail when we get to actual worked examples. Okay, there will definitely be some in the textbook, the study guide, and we can reference some of them, but you'll see lots of them in past papers as well. Okay, are we happy with that section?
Yes.
Okay, these are really, really, really good. Okay, businesses like these a lot. Okay, I can't emphasize that enough. Okay, these are really good. Okay, these are really, really bad. Okay, this is the opposite now. Okay, so what is a prohibited deduction? A prohibited deduction is something that does meet the Section 11A general deduction. Okay, so I'm going to take an example. I'm going to use this one, fines. Okay, and I'm going to use specifically a speeding fine. Okay, a speeding fine. So let's go back to general deduction. Okay, here, general deduction formula. All right, so let's assume you're Uber. Okay, you're running a business. Okay, it's your Uber business. You got a fine, a speeding ticket. Okay, a fine. All right, was it actually incurred during the year? Yes. Was it during the assessment? Yes. Was it in the production of income? Yes. You were on a delivery. Is it not of capital nature? Definitely not. Was it let or expended for the purpose of a trade? Yes, it was. Okay, so a speeding fine meets the definition of the general deduction formula. It meets all the criteria. But what is SARS going to say? No, 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 no. This is a speeding fine. We are not going to allow you to claim a fine as a general deduction because it is part of this list. It's a prohibited deduction. In other words, if it's domestic or if it's private expenditure, they will not allow you to claim that as a deduction. It's prohibited. If it's an unlawful activity, fines, bribes, etc., they will never allow you to deduct that. Okay, if it's other, not meeting the general deduction formula, okay, so other, not meeting the general deduction formula, okay, I think I've worded that incorrectly. Okay, it can meet the general deduction formula, but it's still not prohibited. Okay, prohibited meaning it's prohibited deductions that it's not allowed. Okay, so for example, that example we just used. Okay, if I get a speeding fine because I'm delivering something, There's no way you're going to be able to deduct that. SARS will say it's a section 23.0, not 0, 23.0. Okay, 23.0 meaning cannot deduct. Insured losses, same thing. They'll say cannot deduct. Tax, penalties, interest, they'll say no, sorry, cannot deduct. Provisions, okay, section 23E. Okay, notice these are other provisions, not provisions for bad debts. This was provisions, but for bad debts. Okay, because SARS understands that that can happen, but other provisions, definitely not. Okay, exempt income, definitely not. Non-trade expenditure, definitely not. Restraint of trade payments, okay, definitely not. Okay, restraint of trade payments, those are a bit different to what we had here earlier. Okay, restraint of trade is looking at smaller of given time or 3 years. Okay, a restraint of trade is looking specifically at how can I put it? Not allowing an individual to disclose information to a competitor. Okay, that would be a restraint of trade deduction. Okay, where the company is making a payment for that specific purpose. Right here, a restraint of trade payment, when it's section 23L, okay, there's certain scenarios where you cannot claim that something is a restraint of trade. Okay, where you're going to pay them and you're going to continue to pay them because you don't want them to disclose, not disclose, but to how can I put it? So for example, you're paying someone, but you're paying someone not to protect your ideas or your trade secrets. Okay, it's let me actually see what they refer to it as, the right words. Let me get the right words instead of trying to think of it. Where's my? Let me get an example for you. Where was it? I think I closed it. Did I close my Google? Yeah, looks like I did. Okay, let me open it again. Okay, section 23L. Restraint of trade. Here. Okay, there we go. All right, so if you go to this restraint of trade payment, okay, but this is actually part of a PDF. Okay, I don't want to open up a PDF. I'm just going to open up this here, SICA. Taxpayer restraint of trade. Okay, we're looking for section 23L though. Here's section 23L. Amounts received for restraint of trade. Okay, maybe this one's better. Let's see if there's a better one. Maybe this one. No, not quite. Let's see. Okay, we might have to use one of those ones then. Okay, let's use the one of the PDF ones. I'm going to open up this one. Okay, let's search for it. Oh, that didn't find it. Okay, okay, they've given you that. How many do we have here? 13. Not that one. Okay, this is part of it, but not quite. Let's just look at the compensation paid. Okay, there's the amendment here. The effect of the amendment is to specifically include restraint of trade payments received or accrued to in gross income. Okay, so remember we said, go back. Okay, what is this? It's a prohibited deduction. Prohibited means what? I cannot claim this as a deduction. Okay, so a restraint of trade payment cannot be claimed as a deduction. Right, so in other words, it's not going to reduce your income tax. Because last week's notes, let me open up last week's. On last week's notes, you would have saw restraint of trade as being a specific inclusion. Let me show you this. Okay, last week when we spoke about specific inclusions, here, specific inclusion, okay, they didn't include restraint of trades here because we're looking at companies. Okay, companies can't earn a restraint of trade. Okay, you can't stop a company. Remember, restraint of trade only affects people. Do you agree?
Yes.
Okay, so if you're an individual, as an individual, you will have to include a restraint of trade as part of your gross income as an individual. Okay, not as a company. Obviously, companies can't have a restraint of trade. That's what we're referring to here. Okay, notice it must be included. Okay, now we need to look at the actual deduction. Let's find that bit here. Where a payment received or accrued in respect of restraint of trade is of a capital nature. See? Capital nature. It will be taxable in full. Okay, capital nature meaning it relates to capital, not income. Okay, it must be taxed in full. Okay, that's for the natural person, the person receiving it. It's like normal income actually for the individual. Okay, but you're just not working. Okay, you're paid not to work because you have knowledge of the company's trade secrets and they don't want you to work for a competitor. Let's find the deduction here. There we go. I saw it already. Deduction. On the deduction side, Section 23L provides for a general prohibition. Okay, prohibition means you cannot deduct it in respect of a restraint of trade payment. However, provision has been made for a deduction in terms of Section 11CA. 11CA is what we're looking at here. Here. Go back to this one. Here. There, restraint of trade. This is Section 11CA. Okay. Restraint of trade. This is the specific deduction. Okay, if you go back. All right, so you do have a deduction. Section 23 does not allow it to happen. So in other words, you're not allowed to deduct it. But Section 11CA does, as long as it is very, very, very specific. Okay, and they'll never ever ask you this. Okay, I've never seen a question about this, but I'm just sharing it with you because it's on both slides. Okay, but here's the detail. Section 11CA, it's a capital A. I actually need to change this. Okay, CA. Just to make it in line with the legislation. Right, are you a natural person? Notice it's a natural person. You're not dealing with natural persons in Tax 2601. In Tax 2601, you're dealing with company. That's why you'll never see this. Okay, but if it's it'll be allowable. So in other words, it'll be deductible as long as you meet the criteria. Okay, so you must be a natural person, is or was a labor broker, okay, is or was a personal service company, is or was a personal service trust. Okay, notice, to the extent that such amounts constitutes or will constitute income of the person to whom it is paid. So in other words, if you're getting the restraint of trade, it's obviously seen as income, then a portion of it will be deductible. Okay, what is the portion that will be deductible? So much of such amount, so incurred as to equal to such amount divided by the number of years or part thereof during which the restraint of trade shall apply, or 1/3 of such amount. Okay, and that's why you have this in your notes. Okay. Let me just delete this. Smaller of the given time or 3 years. Okay, so if you have a 2-year restraint of trade, okay, obviously the smaller of the given time, 2 years or 3 years. 2 years is smaller, you would use 2 years. Let's assume it was a 5-year restraint of trade. If it was a 5-year restraint of trade, then you would use 3 years. Okay, that's what you're using. Okay, there's a reason why this is in blue. Okay, this is new legislation. It came up quite recently, not that long ago. Okay, so let me go back. Where else? What else do we have here? That was it. There. Section 23 provides no deductions shall shall in any case be made in respect of the following matters, namely, okay, any expense incurred in respect of the payment of any restraint of trade, except as provided for in section 11a. C. Okay, there's always a special inclusion or a special deduction, okay, or a general deduction. Do you see that?
Yes.
Okay, so it applies to both. It can be included or it can be excluded. It all depends on the type of deduction that you're applying. Okay, but it must be very specific. So it must be natural person, labor broker, personal service, or personal service trust. Do you see that?
Yes.
Okay, yeah, but that's very, very, very specific, right? It's quite obvious in tests and exams. You'll see. All right, so I've included it there because it is something that came up in one of the exam papers. Then we had to look at it in more detail. So I've actually added it to the actual notes just to make it a little bit more noticeable. Okay, because we were debating it and we were discussing it because it has to be included, but only in certain specific scenarios, and in most cases it will be excluded. Okay, prohibited deduction. Okay, when you're making that payment. Okay. All right, does that make sense?
Yes.
And then the last one is what we spoke about earlier. Fines, unlawful activities cannot be included as a deduction. And then the last bit, other. Other prohibited deductions include income carried to a reserve fund, monies not expended for the purposes of a trade, and any taxes, duties, levies, interest, penalties, etc. Obviously under the SARS Income Tax Act, okay, from the Commissioner. All right, the last bit we need to look at is trading stock, trading inventory. Okay, do you remember your trading inventory from FAC? What is inventory?
It's goods to be resold or
Very
resell.
good. Okay, trading stock is going to be bought to be sold. Do you agree?
Yes.
Okay, so when you covered FAC 1502, you would have learnt about periodic versus perpetual. Do you remember the difference?
Yes. So periodic is where you do stock take, and perpetual is literally like every item that's sold.
100%. Nice. Good answer. Okay, so the reason why I'm giving you this is because it's so easy. You don't have to study it or you don't have to remember it. You can just apply it. Okay, so do you agree when you're looking at the periodic system, you have a cost of sales formula? There's the equation. Do you see it?
Yes.
Okay, so when you have trading stock and SARS in terms of tax, because remember, businesses are going to be operating, and then businesses will have a certain amount of opening stock, and businesses will have a certain amount of closing stock. So now the big question mark is, how much can they deduct and how much can't they? Do you agree?
Yes.
And that's the big challenge when you're looking at tax, is what are you allowed to deduct and what aren't you? So when you look at the opening stock, okay, opening stock is obviously a positive figure. Closing stock is obviously a negative figure. Do you agree?
Yes.
Okay, so if opening stock is more, so if I have opening stock, if I have more opening stock, I'm going to have more cost of sales. Does that make sense?
Yes.
So if I have more opening stock, I'll have more cost of sales. Cost of sales is an expense. So what does the expense do? That means it's deductible. Okay, do you see that? Do you see that logic?
Yes.
Okay, so with opening stock, because opening stock is going to increase your cost of sales, you actually subtract it in terms of tax. Okay, so when you do a tax calculation, which we will get to later on, okay, you will subtract your opening stock. It is, inverted commas, deductible. Okay, when you have closing stock, what does closing stock do? It's a subtraction, it's minus. So if closing stock, other way, if closing stock is going to increase, it's going to make this negative bigger. Do you agree? If this is a bigger negative, it's going to make cost of sales smaller. Do you agree?
Yes.
If you have less cost of sales, you'll have a smaller deductible. Does that make sense?
Yes.
So you basically have to add it back. Okay, so closing stock you add, opening stock you subtract. Does that make sense?
Yes.
Okay, and I'll show you an example of it just now when we get to the study guide. Okay, that's the last bit we need to look at. Something else that I've included here from 1502 is your historical costs. Okay, if you've got any of these things, okay, because it relates to inventory, would you say these are deductible or not?
They should be deductible.
Exactly, they are. Right, because it relates to inventory. Remember, inventory is bought with the intention to sell. Do you agree?
Yes.
Okay, so you can have other costs as well that are related to the inventory, and those would be seen as deductible. All right, that wraps up the notes. Let's go to that study guide just to show you some examples. Let's see what they've given you for study unit 5. Okay, they've looked at deductions. Notice how they've broken it up. This is a really nice summary. General deduction, that's the section 11A where you have those 5 criteria and almost anything can be deducted. Okay, I'm just trying to summarize what we covered today. Remember that? Happy with that?
Yes.
Okay, if it doesn't fall under the general deductions or it doesn't meet the general deduction formula, it might be considered a special deduction. And then SARS will actually allow you to deduct it because they understand that businesses have those expenses. Prohibited deductions are deductions that meet the general deduction formula, meaning you could possibly deduct it, but SARS specifically says no, you cannot, because it's against the law or it doesn't or isn't allowed. Okay, happy with that?
Yes.
Okay, in study unit 6, next week, we're going to be looking at capital allowances. That's another part of the deductions. Okay, deductions and allowances. Right, so next week's notes will be looking at that. Right, what else do they give you here? Let's see. Okay, they've referenced some of the textbook, so please have a look at that. There's some background here regarding the general deduction. That's fine. We've looked at this. General deduction formula. It's in the textbook. It's in your notes. We've looked at it. We've discussed it. Okay, there's the note. See? Deductions are allowed in terms of. There's a whole bunch of them. Section 11A is general, and then you've got specific ones. Okay, you've got 11 other ones. 11E, for example, 11E is wear and tear. Okay, that's a deduction next week. Okay, there are other ones that are more specific. Okay, specific deductions. Okay, all covered in section 11, but obviously different paragraphs. And then you've got section 11G, which relates to those other general deductions. Okay, those other deductions. Case laws we spoke about. Remember, cases are important because cases show judgments that have come from certain disputes. Okay, it could have been a company disputing something with SARS, and it gets taken to court. Right, the interpretation has to be followed in terms of the case law. So what the case is, the judge will obviously rule on. Okay. Happy with that? Does it make sense?
Yes.
Okay, we spoke about trade. Okay, what determines or constitutes trade? In other words, business. Right, the principle here. See, there's that case, burgers. Okay, they've obviously given you a bit more information here. I've summarized it in the notes. Here they said to be able to claim an amount under Section 11A, it is necessary for a taxpayer to be carrying on a trade. See? Very, very important. Right, if they're not carrying on a trade, so no continuity, okay, if they're not operating, okay, if there's no motive to make a profit, then you cannot consider that deductible, okay, and SARS will never allow you to deduct it, right? So if you're going out of business, okay, and you're not carrying on a trade or there's no continuity, they're not going to say that's carrying on a trade. It will be seen as capital. Okay, tax versus accounting. We spoke a little bit about that earlier on when I spoke about cash versus accrual. Do we have to have cash for something to be deductible, or can we have an accrual? Must it be cash, or can it be an accrual? Yes, it can be an accrual. That's correct. Okay, the definition talks about this. Actually incurred, expenditure and loss. It relates to your accounting. Okay, this is taking this further. All right, we're looking at tax, we're not looking at accounting, but you can use your accounting knowledge to help you with the tax application. Right, actually incurred, there should be a note here. Yeah, there. Edgar Stores, actually incurred. Okay, the principle. Before an expense can be deducted in terms of Section 11A, it must be unconditional. That is, the expense must not be contingent. The event must have taken place. Okay, so you can't claim expenses that you're going to pay in the future. Does that make sense?
Yes.
Remember, SARS is going to allow you to deduct certain expenses, only the ones that have been incurred. SARS doesn't allow you to deduct things that haven't happened yet. Okay, that's just the basic underlying principle, which makes common sense. Well, there's an example here that you can have a look at, which will explain that. During the year of assessment, also pretty easy, must be in the 12 months of the tax year. There, production of income. Here's the PE electric tramway case. Okay, I see this is quite good. They've even given you more detail here. Inevitable concomitant or closely connected test. That's good. Okay, that's what we spoke about earlier. Okay, that's the summary. What does that mean? Well, if you look at the details, okay, it should be determined whether the task was necessary and whether an expected or foreseeable risk was attached to that task. Thus, it should be asked whether the expense is so closely connected with the income earned that it may be regarded as part of the cost of performing it. Okay, notice how close or how inevitable is that expense in the production of income. Okay, production of income meaning, so for example, I have to put fuel in the vehicle. Fuel would definitely be deductible. Does that make sense?
Yes.
Okay, because it's part of the production of income. How closely connected is it to the carrying on of business, basically? Right. There's an example here. These ones I'm going to ask you to just have a look at in your own time. I see there aren't many, but there's a few here this week. Not of a capital nature. That we also spoke about. Tree and the fruit principle. Enduring benefit. Did they give you anything about that here? Let's see. No, not quite. I didn't see enduring benefit here. But they did talk about the tests. Okay, those tests relate to what we spoke about last week. Capital versus revenue. Okay, but except we're not looking at income. We're looking at deductions. With deductions, nature of the transaction, closeness or connection to the income earning operations. Okay, enduring benefit is there, but looking at creating an asset or advantage that provides an enduring benefit, then something will be capital. Once or for all expenditure and nature of the business that is carried on. There's the new state areas case. Expenditure is to be regarded as part of the cost of performing income earning operations or as part of the cost of establishing, improving, or adding to the income earning structure. The so-called operations versus structure test. Right, in other words, the tree and the fruit principle. Okay. Other tests that can be used to decide and help the matter were the fixed versus floating capital to test whether there is any enduring benefit or permanent asset created by the expenditure. Right, so here's a quick example. Let's talk about cars. Okay, if I buy new mags, okay, if I upgrade the wheels, okay, and I put nice mags on the actual car, would you say that's capital or revenue?
Would it not be
Which one?
capital?
Good. Why capital? You're right. Why?
Because it's not your product or it's not your service.
No, not quite. We're talking about this fixed versus floating, improving or adding to the income earning structure. Okay, so do you agree if I buy mags for a vehicle, the mags improve the vehicle?
Yes.
Okay, if I buy tires for the vehicle, that doesn't. Because tires don't have any enduring benefit, there's no permanent asset. Does that make sense?
Yes,
Okay, the
yes.
tires lose their tread. Eventually, you're going to replace the tires, but you're not going to replace the mags.
Okay.
Okay, so the actual metal part of the wheel you keep. The tire part of the wheel that you would not be able to. So if you buy mags, it's capital. Okay, you can't deduct that as a deduction. Does that make sense?
Yes.
But if you buy new tires, now we're talking about repairs and maintenance. The tires you could say is income, and that could be deductible because the tires you could motivate as not being capital in nature because there's no enduring benefit. Does that make sense?
Yes.
Okay, good. All right, and that's what they've tried to show you here in terms of floating capital that's actually going to be used enduring benefit, making a profit, part of income or part of capital. Okay, it's always a debate. Okay, if I buy machinery, machinery is obviously capital. If I buy goods, goods are obviously income. Okay, another example here that you can have a look at, and then let's see what else they give you. Okay, special deductions, specific deductions. Okay, they haven't given you much here. I've given you more in the notes, but that would have come from the textbook. So you can refer to that here, I see. There'll be a longer list there and there'll be more information. They do want you to look at some of these sections, not all of them. Okay, that we've covered before in accounting. That doesn't come up that often in Tax 2601. Okay, it's spoken about, but I've hardly seen it in test papers. Okay, legal expenses we spoke about. Restraint of trade. Okay, here's that whole 3 years, the lesser of 3 years, and the amount. Okay, this is quite a good example. This I would definitely say please have a look at as in terms of example. Okay, it's what I spoke about earlier. If it's 3 years or 2.5, which is shorter, 2.5. Do you agree?
Yes.
Okay, so it will be the shorter of the two. It wouldn't be the 3 years. Okay, let me just go back to the notes and show you that again. Here. Okay, the smaller. So the deduction. The deduction will be the smaller of the given time or 3 years. Okay, so the restraint of trade will be the smaller amount. So it'll either be the 2.5 years or the 3 years, but the smaller amount. Okay, the smaller of the given time. Well, I don't think this is too long. Let me look at it quickly. Then at least we've covered it. Then you have to worry about it. Okay, it's not the lesser of the number of years. Okay, it's the lesser of the amount. Okay, so if I have 2.5 years and 3 years, notice I need to use both. Okay, because I've got 3 years here, I need to work out the difference. I need to divide. Okay, so what is 3 million divided by 3? It's 1 million. Do you agree?
Yes.
3 million divided by 2.5 is 1.2 million. Which is the smaller amount? 1 million or 1.2?
1 million.
1 million. So 1 million will be the deductible amount. Does that make sense?
Yes.
Okay, yeah. So the smaller of the amount. Okay, so when you see this, you have to do a calculation. Okay, you have to actually show that. When we do past papers, you'll see I do all the workings on the actual calculation. Okay, and you'll see it's quite easy to score marks as you go. But obviously that's written. I don't know how it's going to work if it's multiple choice. We're going to have to see. Okay, later on. Okay, there's the registration, acquisition, and patents. I did give you a summary of it in the notes, but they've given you more information here. They're referring to 11GB and 11GC. Okay, these relate to registration and acquisition of patents, copyrights, designs, and trademarks. Okay, here they've given you more. Okay, this you can actually complete. Expenditure less than 5,000, the allowance will be, it's in the notes. It will be full. Okay, if it's greater than 5,000, if it's a copyright, it's 5%. If it's a design, it's 10%. Okay, so you can fill that in your notes if you want to. It's full. A here will be full deduction. If it's less than 5, it's full. Expenditure greater than 5,000. If it's greater than 5,000, it could be B or C. It's B. If it's B, it'll be 5%. If it's C, it'll be 10%, depending on whether it's a design or a... What is the other thing?
Copyright.
Yes, 5% for the copyright, 10% for the design, correct. Okay, so we've answered that. That comes out of the textbook, actually. But you can look at it in the legislation. All right, the rest is fine here. They're just referring more to it. Okay, research and development. This we'll look at later. We will look at capital allowances, capital assets used for research. Okay, bad debts and doubtful debts we spoke about. It's 25% limits. Contributions made by an employee to a provision. Okay, that also we've looked at. That was also covered. The textbook's also quite good. They'll give you a bit more information. The donations also, they've given that to you there, 10%. Okay, former employees, that one doesn't really come up. Prohibited deductions, then they should have listed them all. Yes, here they're there. Okay, there's the list. Okay, prepaid expenses, what we spoke about earlier. Remember the prepaid expenses was or less than 6 months or less than 100,000. Remember that?
Yes.
Okay, so in this example, I have annual license fee of 100,000. It's paid on the 1st of January. Okay, the company's year end is March. So obviously January, February, March, that's 3 months. Do you agree?
Yes.
So 3 months falls as part of that year. Then you'll have 3 times 100,000 divided by 12 gives you 25,000. 25,000 will be deductible for the current year of assessment. Obviously because that was during the current year. Does that make sense?
Yes.
Okay, but now what happens to the prepaid expense? What is the prepaid expense? 75,000. This 75,000 is going to take place in the next year. Do you agree?
Yes.
Okay, so how many months do we have in the next year? Well, we've got 3 already, so we've got 9 months. Do you see that?
Yes.
Okay, so is this less than 6 months? No, it's 9 months. It's longer than that. Then the next thing we need to check is or. Is it less than 100,000? It is less than 100,000. So if it's less than 100,000, you're going to be able to deduct it. Does that make sense?
Yes.
Okay, and that's exactly what they're saying here. Okay, the 25,000 is during the current year, so it meets the section 11A, basic general deduction formula. The 75,000 is a prepaid expense. Then you need to discuss what we just looked at here. You need to use this. Okay, is it greater than 6 months? It is. Or it's less than 100,000. It's less than 100,000, so it must be deductible. Okay, they should have explained the same thing there. I'm just trying to shorten it a bit. Okay, final conclusion, you must deduct it because it's less than 100. Happy with that?
Yes.
Okay, the time isn't the time isn't so important if the amount is less than 100. It's or. Or means one or the other. It doesn't have to be both. Here's the trading stock. Let me see here. There we go. See, opening stock. What did we say we're going to do to opening stock?
Deduct it.
Yes, we said we were going to subtract. Remember that? Because opening stock is going to increase your cost of sales. Cost of sales is an expense, so you deduct it. So you deduct your opening stock, and then you add back your closing stock. Does it say that here? Yeah, closing stock is income in the hands of the entity. See, you add it back. Okay, closing stock is actually a special inclusion. Okay, so you add back the one, you subtract the other. Make sense?
Yes.
Okay. What else is there? Oh, okay, here's the opening stock. There's an example. No example. Closing stock. Yes, here's an example. Perfect example. M Limited purchased stock for 60,000. It incurred handling fees of that and the transport fees of that. Okay, obviously those are fees related to delivery and handling. Do you agree?
Yes.
Okay, so those would be deductible. The solution, the 60,000, yes, plus that 60,000 is the cost price. Yeah, that's right. Okay, you're adding that to your cost price to work out the amount that you would be deducting depending on the opening or closing stock. Stock acquired for no consideration, private or domestic consumption. Oh, okay, so this is just another consideration where you have private or domestic consumption. So what happens if you take stock for your own use?
You can't deduct it.
Yes, it must be included as a recruitment. Okay, so any stock. So if I buy stock here, cost of the taxpayer is 6,000, is removed by him for private use. I've taken stock for my own use. The market value of the stock to date is used as 8,000. Okay, what is this effect on taxable income? Notice the taxpayer will include a recoupment. A recoupment is a special inclusion. Okay, you're adding it to your taxable income. You're not going to be allowed to deduct it. They're definitely not going to allow you to deduct this as a deduction. It just wouldn't be fair. Okay, because then owners will take, and they'll just deduct. Does that make sense?
Yes.
Okay. What else do we have? That's it. Looks like it. Yes. There was something. I don't know if they've included here. Looks like they haven't. But there's something called the lower of cost and net realizable value. Let me see if it's here. Okay, it comes up in some of the questions, but it doesn't. I don't see it here actually. Okay, we'll get to it when we get to it then. Looks like they haven't included it, but I've noticed it in some past papers and in some examples as well. They talk about the lower of cost and net realizable value. Okay, but we'll get to it eventually. Let me just see what they've given you here. Where's the self-assessment question? Okay, there's a few here. I just want to look at the one where you have the stock, just to see if they've given it to you here. No, I don't see stock in this one. The next one? Nope, no stock. Number 3, taxable income. Okay, these are all the outstanding items. Where's opening and closing stock? I want opening and closing stock. Nope, I don't see opening and closing stock here either. There must be one. Do you see one with stock? Maybe this one then? No stock. Gross income. Compensation. Debtors. Legal fees. Penalties. Bad debts. Yeah, looks like we're going to have to wait for tests and exams and then it comes up, but I see there's nothing here. This is a loss. That's not opening and closing stock. These are annuities. This is the labor. This is debtors. Nope. Yeah, no opening and closing stock. Okay, this is not good. Their examples haven't improved. The examples have gone backwards. There used to be examples showing opening and closing stock. Yeah, it's a pity I can't show you one in your notes, okay, in your study guide. It's not given. I'm going to have to wait till the past papers to show you the workings for that. Let me just go to activity 5. Let's just have a look at this. Where's 5? Here. No. I'm looking for solutions. There. Okay. It starts here. Okay, so yeah, there's the general deduction, subjective test, objective test. Oops, I bumped that over. Okay. 5.1. Yep, see, nothing there. There's no opening and closing stock. That's not a good example. We're going to have to wait till past papers, then I can show you that. This is theory. And this is study unit 6 already. Yeah, no. Okay, yeah, the examples aren't better than before. The examples have not... The examples now are worse than before, and they don't give you as many either. They used to give you a lot more, which is a pity. Looks like we're going to have to wait for past papers and the assignment. I'm just scrolling further down. Maybe in later activities, there might be costs of sales. No, see, even in these ones, no. Yeah, unfortunately, if the examples aren't so good, we're going to have to look at past papers later on. And I'm going to have to look at the assignment with you. Okay, yeah, there's not a lot of examples. Those examples are actually quite basic from what I've seen looking at the solution. They're just looking purely at deductions, the things that you subtract, that's all, in line with what we had looked at here. So I'm going to ask you to try have a look at those. Just go through these ones you can. Okay, remember we said study unit 1, 2, and 3 you can't. Well, 1, 2, 3, and 4 actually. You can't because you don't have solutions to them. Okay, for this one you can. So this we can discuss next week. So this week you have a little bit of homework. I'm going to ask you to look at these questions. Okay, there's 3 in total, 2 in total, 2 or 3. Yeah, there's two, looks like it. Oh, three. There's three. Okay. Solutions to questions 5.1 and 5.2 are provided. And then what about the third one? Oh, and then the other solution will be provided online on my Unisa. Okay, I don't know why they do that. Okay, before they gave everything, now it looks like they're going to be giving it to you as and when they want to. I don't know if you're reading this. Can you see this, Cheryl?
Yeah. Yes.
So is that the same here with number 4? Maybe we need to wait for them, looks like it. I actually haven't noticed that. I'm just noticing it now because you can actually do these questions and then we can check it next week if you've got any problems. Let me quickly open up this page and just see, did they say that in this set of notes? I hope not, because then we have to wait for them. Normally they give it to you ahead of time and you can do this as and when you wish, which is ideal. I don't know why they're holding back information. That seems a bit weird. Just give the students everything they need and then let them go on their merry way. But that doesn't seem to be the case. Did they say anything here about solutions? I don't see anything. Let's scroll further down. Activities. Okay, here. Ah. Okay, now we know why we don't have solutions in the study guide. Cheryl, have a look at this.
Yeah. Lord.
Okay, so I don't know when we're going to get those solutions, but we're going to have to wait for them. Okay, normally they give you the working, like I think I showed you, I showed you the old tutorial letter from from 2 years ago, and you saw all the solutions in that one. I don't know, but now it looks like they're keeping it and then they're going to post it somewhere at a later stage. So maybe just keep your eye out. Keep your eye on my Unisa. When the solutions come out, then we can actually go through them in more detail. Maybe what I can suggest you do, if you want to, you can just practice a few of them. Okay, they're obviously covering something specific, and we could just go through one or two of them, or you could just go through one or two of them. It's up to you, and then we can discuss them later. Obviously, I want to get to the assignment, and then much later do past papers with you. But this is a wait and see. Okay, we're going to have to wait for this, and we're going to have to wait for the other one as well, looks like. If that was what was given there, it should be the same thing here as well. Yeah, it's exactly the same. Okay, so now we know. Okay, we've discovered something. We need to wait for them to give the solutions. Okay, so will you keep an eye out on my Unisa and maybe just post and ask them when will you be given the solutions?
Okay, I will.
Yeah, because you do need them just to practice. But yeah, we can look at past papers and we can go through those, but much later on. Ideally, I want to get through assignment 2, which is soon. We've got 2 more units to get through, unit 6 and 7, and then we've covered it. Okay, so unit 5, there's only 2 questions that you can have a look at. 5.1 and 5.2, you can look at. If you get stuck and you're not too sure why they're doing something, then let's discuss that at the beginning of next week's content, just so we can address any issues from this week. Is that all right? Does that sound good?
Yes.
Okay, so yeah, just work through those and just see if you're comfortable with what they've done. Okay, remember it all relates to what we spoke about here. This working. Okay, income, write down everything. Deductions, allowances, write down everything. But you have to write them down in lines. So you write on one line, another line, another line, another line, and you're just applying the rule. Okay, the nice thing about tax is everything is separate. Okay, when you look at income is income, you apply income. When you look at deductions, allowances, you look at deductions, allowances, you don't look at anything else. Okay, that's the nice thing about tax, is it's very separate. Okay, you look at the specific rules for a specific section, right? And when we look at big questions, okay, questions can be out of 20, 25 marks. Then when we do those long questions, I'll show you exam technique. Okay, when you get to something, you look at it, you go to the section that it's covered under, and then you just address it. Okay, nothing will overlap, nothing will affect something else. It's all independent, which is nice. And that's why you can do quite well in tax, because everything is separate. Everything has its own rules. Everything has its own calculation. Okay. All right. Is that all right? Are you okay with that?
Yeah. Yes.
Awesome. Perfect. Okay, Cheryl. So that pretty much wraps up that section. We've covered 5. Have a look at those 2. They don't look too long. This one should take plus minus 19 minutes. This one should take plus minus 18. So around half an hour of activities. Okay, they look quite nice. The one that I saw earlier was theory, and then the one that I saw was calculations, practical. Okay, so you've got a mix of both. So that's a nice way to start in terms of workings and calculations. Okay, all right. So we can discuss that next week, see how it goes, and if you have any problems, then we can address them before we start with the next section. Because the next section is going to build on what we covered this week, except we're not going to be looking at revenue. We're going to be looking at capital. Okay, capital allowances. All right. So part of this bit, not so much that bit. Okay. All right, happy, Cheryl?
Yes.
Awesome. Okay. All right. Hope you have a good week. Take care, stay safe. Hopefully the weather improves. And then I'll see you again next week for Study Unit 6.
Okay. Thank you so much, Anthony.
Okay. Just before you go, did you get the link from YouTube last week? Is it coming through now?
Yes.
Okay, great. Yeah, because I did check. So when I send it to you, I also send it to myself. So I did see the links getting sent again. So I think they might have just stopped it for a bit, but I see it's coming through. So if I don't get a link, then I'll obviously just send it to you as well, because then I suspect you wouldn't have received it. But yeah, so I'll obviously upload the video later in the week in case you want to go back. We did do quite a lot today, so quite hectic. I hope it wasn't too much.
No, it wasn't that bad.
Okay, great.